All right, good morning, people, or afternoon, depending on what period you're in. Obviously, I'm not here today. My mom is sick, who I get childcare from on these days, and my wife has like a million meetings today, so I had to stay home with the kid. So here is your video lecture of 3.2, the stock market in depth. I will be back next class on Wednesday. Also, just so you know, if you are a person who is doing Cyber High today, I will be there for Cyber High. In fact, if you're in fifth period, I'll probably be coming into the classroom with about like 5 minutes left of class. So make sure you're on task. Don't disappoint me when I come back. So if you have not yet done the check-in survey, please back out of this, do the check-in survey, and then come back. If you're here, you should have your notes out because you should be taking notes on this as we go. Let's go ahead and get started. So first off, I want to go through some vocabulary and some terms that you might see as you are researching stocks to buy for the stock market simulation. The first is going to be revenue. So this is not a new word. We used this last unit when we talked about cost of production and profit and things of that nature. But when we're talking about revenue, we are talking about, if we're talking about a company's revenue, we are talking about the total of all the money that they receive from whatever they are selling, whether that is a good, a service, or both. Okay. Then profit is going to be their revenue minus their cost of sales. So how much it costs to produce those goods and services. Okay, those two are not new. But then earnings is something that you will see really regularly when you are researching stocks. And so when you see earnings, so sometimes you'll see this as like a quarterly or yearly earnings report. And so earnings are going to be profit minus taxes and capital expenditures. So if you remember from Unit 1, capital is going to be goods and services that are used in the production of other goods and services, right? So when we're talking about measures of income, or when we're talking about earnings, okay, the reason that this matters is because earnings is going to be a better picture of what a company is doing and how strong they are, economically speaking, than revenue or profit. Because businesses, over the long term, you want to see them expanding and growing to be able to purchase or to be able to produce more and more goods and services. And so earnings, which accounts for how much they're paying in taxes and the capital expenditures, meaning the cost of the goods and services they need to increase production in the future, right? That is going to be a better picture. Now, oftentimes, a strategy in investing in the stock market, especially in the short-term way that we're going to be investing in the stock market, is to watch out for when a company is about to put out their earnings report. And so oftentimes you can kind of find articles that will talk about what people think will happen in a company's earnings report. You can predict what you think is going to happen. And then when their earnings report comes out, and they report to their shareholders, here's how much profit we made, here's the taxes, here's our capital expenditures, here is that total, that difference. If it's greater than what people thought it was going to be, usually the stock price will go up. If it's less than what people thought it was going to be, the stock price will go down. Now, the reason that public companies have to put these out is because people in the public own a portion of that company. And so they have to report to the people who own the company, which in this case are stockholders, what is going on in their company because they're a publicly owned company. Now, let's get into a topic that you watched an Edpuzzle about, and most people, this is their big question, right? Why do stock prices change? And the answer is both simple and very complicated. The simple answer is just supply and demand, right? There is a supply of stock, right? People who have shares of different stocks and want to sell them at certain prices, and there is demand for those stocks, right? All the different quantities demanded at each different price. Now, there are going to be a huge amount of different things that will shift the demand or the supply for a certain company's stock, but for the most part, it's due to expectations. Now, those expectations could be about, right, if we expect the future price of the stock to be high because of blah, 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 right? We might want to buy a lot more now. If we expect it to be lower in the future, we might want to sell more now and buy less. And so what happens is if you were to draw a simple supply and demand graph, right, and you would see, oh, if demand increases and shifts to the right, that raises the price, right, the equilibrium price. If supply increases, right, that is going to decrease the price, things like that. So keep that in mind as you're going through. Now, why do stock prices change? Now, it could be everything from, like I talked about on the last slide, an earnings report, actual information about a company, right? Now, I want to make it super clear. There is no actual direct link between a company's ability to make money and being a quality company and their specific stock price. So I don't want you to think that, like, as a company makes more money, their stock price automatically goes up. Not true. Often it does, but that is not a mandatory direct link, right? So keep that in mind. Now, in reality, what happens in the stock market is you will see unrelated events. So events that have nothing to do with the company that you're talking about impacting the price of stock of the company you're talking about. So let me give you an example. About a week and a half ago, the U.S. and Israel fire missiles into Iran, right, and start this war in Iran. Now, when that happens, the stock market tumbled a little bit, right? On a whole, in general, many different companies' stocks started to decrease. Okay. Now, does that mean that Amazon as a company is doing worse? No, not at all, right? Amazon as a company is probably doing just fine. There's probably no change in Amazon's ability to make money. But people and investment banks on a macro level, there are millions and millions and millions of different people, banks, and dollars invested in the stock market. And so what happens is when those people are less sure about what is going on in the world, right, are concerned about what is going on in the world, they might sell more stock, which causes the price to decrease. Flip side, if people anticipate something happening that, or they're feeling very secure about the future, they might increase how much they buy, which is going to then increase the price. So I want to make it super clear. There are things about companies that will directly cause a change in the stock price, right? About 8 years ago, there is at the very beginning of the stock simulation, a Boeing made plane crashed due to a malfunction, and their stock price went down by like $80 a share, right? Now that's directly because they made a bad plane and it broke, right? Now, just recently, right, a bunch of major stocks have gone down about 5%, 3%, not because their company is worse. So keep that in mind. Now, some other terms you might see are bull and bear market. Bull markets are the description of the stock market in general when it's usually trending upwards, and so we're talking about over the course of a longer time period, increasing by about 20%. A bear market is going to be the opposite, trending downwards. The way to think about this is when a bull kind of attacks something, it is pushing its horns up, where when a bear attacks something, it is standing and hitting down, right? And so generally, a bull market is when prices are going up of stocks. Bear market is when they're going down. Now, another term that you need to know before we get into kind of some strategies and more in-depth versions of the stock market. So an investment portfolio is basically the collection of all of your investments, all of your assets, right? So in this course, in this unit, we will talk a lot about your portfolio, right? So on Wednesday, when we start the stock market simulation, your portfolio is going to be mentioned a lot. Your portfolio is your collection of all your stocks. In real life, that would also include any other investments that you have as well. Now, when we are talking about a portfolio, a good piece of advice is to do what we call diversification. So diversification is basically spreading out the amount of money you have invested in the stock market into different industries, different risk levels, different types of company, right? So for example, if you have everything that is very high risk, it means that you could potentially lose all of your investment money very quickly, right? If everything is very low risk, you might make a very small amount of money only because your those stocks are not going to make as much in a year. If you have all of your stock purchased in tech companies, but then something happens where people are not buying that technology as much and all those prices go down, now you have far less money. You want to be diversified. And so one of the things that I will talk about in the stock market simulation, you'll write about, is how did you diversify your portfolio? Okay. To make sure that you have some high risk, some low risk, some moderate risk, some sectors, some different parts of the economy. Now, next thing we're going to talk about is risk, which was referenced on the last slide. So risk is all about the chance that you're going to lose all or part of your investment in a certain stock. Now, there's going to be 3 levels of risk: low, moderate, and high. So a low risk stock is going to be more secure. It's going to be what we call fixed income investments. So this is going to be like it gives you a dividend, it pays you a dividend each month, something like that, right? The value or price of the stock doesn't change very much. Okay. Now you can also, by the way, apply these definitions to other investment techniques, which we will do after spring break, just so you know. But this slide, it's all focused on stocks. So conservative or low risk stocks, the value doesn't change much, the price doesn't change much, but it pretty consistently goes up at like maybe half a percent to 1.5% per year, right? So low risk stocks are really good options as like a baseline, as like a base of your investment portfolio. So for example, by the way, again, I am not a financial advisor. This is easily accessible information you can find anywhere on the internet. But I'm not advising you on how to buy stocks, just so you know. So if you, in the stock market simulation, really more so in real life, right? If you know you're going to retire in 40 years and you need the money in your retirement account to exist 40 years from now, you're going to populate a big chunk of it with low risk stocks, right? Because you have a long time to gain money. Another example of a low risk of like this type of investment and like making sure you have some in your portfolio in real life would be how I tell you all the time: do your homework, do your classwork, because those are easier points to get. And once you have those points, they don't go away. It's like a base where you're never going to drop below a certain grade. Similar thing here. You're never going to drop below a certain amount of value in your portfolio. Moderate risk, or what we call growth stocks, these are going to be companies whose prices are projected to grow faster than stocks of similar companies. So let's say company A, its price is increasing 3% faster, or 5% or 10% faster than company B, but they do the same thing and they're similarly priced, right? Company A would be a moderate stock, a growth stock, right? These stocks are going to get you a higher change in price and generally be fairly safe, but do have the risk of dipping a little bit more. And then speculative risk or high risk stocks, they are going to potentially get you the largest increase in price in a short amount of time, but also have the potential to have the largest decrease in price in a short amount of time. Okay. Now, on this, when we talk about risk, we talk about what's called risk tolerance. So this is all about kind of the level of risk that an investor is willing and able to have, right? Low, moderate, or high. Some things that can influence it, like you can see on this slide: age, right? If you're older, generally you're less willing to have risk in your portfolio because you're closer to retirement. If you're younger, you've got 40 years to make up your investment, right? Income, if you make a lot of money, you can be potentially a little riskier because you have a lot of money coming in to replace it. Financial obligations, right? If you have a lot of debt you have to pay off, if you have a lot of bills, you have less room in your budget for investing, which means that you cannot make up losing a bunch of money, right? As easily. Family situation, right? If you are supporting an entire family, you generally want to have less risk. Where if it's just you might be able to tolerate more risk. And then finally, investing experience, right? Generally, the less experience you have investing in the stock market, the less you know about it, which means that you probably will end up not being as good at investing, right? And so that's going to play a role in it. Now, pause it if you need to keep writing down, as always. Now for this slide, what I want you to do, I'm going to put all of these up. You're going to pause it and you are going to write in your notes the level of risk that each of these have. I will be looking for this when I check your notes. Okay. So, oops, so sorry. I'll just leave these up here. Please pause the video and write a sentence or two of why each of these people has a certain risk tolerance or not. Okay, so if you're back, that means that you did that. So Julie is 26 and just gotten out of a new job at a much higher salary. She is, or has just gotten a new job with a higher salary. She's single, has no loans, and will get a raise within 6 months. What's her risk tolerance? I would say her risk tolerance is pretty high. She's young. She doesn't have a family support. She's making a bunch more money than she was. The thing that conflicts with that would be the fact that she doesn't have a lot of. She doesn't seemingly have a lot of investment experience. However, her money is pretty solid. She doesn't have a lot of financial obligations, so her risk tolerance should be pretty high, maybe medium or moderate. Number 2, Teddy is a single father with 2 children, ages 10 and 12. He wants them to go to college and is putting aside money to help pay for their education. It will be 6 years before he needs the money to help his first child with education. His risk tolerance is, so I would say his risk tolerance is probably moderate, probably not high, but probably moderate. The reason it's not low, even though he has only one income supporting 2 children, is because he needs to make enough money for one of them to go to college in just 6 years. He needs more growth in his stocks. Okay. Number 3, Sam works in a fast food restaurant as a cook. He barely makes enough money to pay the rent and buy groceries for his wife and baby. Sam is 35. His grandmother died and left him $2,000, which he wants to invest. His risk tolerance is. Now, realistically, his risk tolerance is pretty low. Honestly, a financial advisor would tell him to just use that money to help pay rent and buy groceries, not invest in the stock market, right? Cash on hand in his situation would probably be better, but his risk tolerance is pretty low because if he were to lose that money, that could mean that he's not able to buy groceries or make rent, right? And then finally, number 4, Henry is 68 and retired. The company he retired from recently dissolved its pension fund and sent him a check for 20 grand. He's very healthy and expects to live for another 20 years. He gets Social Security and has a small amount of savings. His risk tolerance is. I would say his risk tolerance is also pretty low because he has a set amount of income. He's not making more money each year, which means he can't really replace this money if he loses it. And he wants it to potentially last him for 20 years. That's a pretty lengthy amount of time. So I would say his risk tolerance is pretty low. Now, for each of these ones, I want you to pause it after I put it up on the screen and then write whether you think this company's stock is a low, moderate, or high risk stock. So pause it. Okay, if you're back. Company Clockwork makes clocks. Compared with other clock making companies, Company Clock has the highest revenue and earnings. Their earnings have grown 15% over the past 5 years. The average earnings of the clock companies in the past 5 years has been 10%. So hopefully you said moderate. You said a moderate risk because it's a growth stock. So it's got faster price movement than other companies that are similar to it, but is not necessarily high risk. All right, this next one. Pause it. Okay, come back. If you're done, so Interior Electric announces it's creating an all-electric car, but hasn't come out yet. Based on the news, the stock price increased 20% in the first month. If you buy it now, what level of risk? This is definitely a high-risk stock because the car hasn't been built. It has the potential to bring high earnings if it's successful, but you don't know if it's going to be successful. And also, you don't know anything about the company's car that's coming out really because it's not out yet. And that stock price of 20% increase is pretty drastic. Okay, next one. Pause it. All right, Jack's company provides natural gas and electricity. They pay an annual dividend of $4 per share. You own 200 shares, pays you a yearly dividend of $800, et cetera, et cetera. This is going to be a low-risk stock. Fixed income stock, right? It's going to pay you a certain amount. It's pretty low risk. Okay. Now, a couple other term that you're going to need to know, and then we're going to kind of get closer to wrapping up. So the beta number is basically a calculation that tells you something about the level of risk of investing in a stock. Okay. So when a stock has a beta number of 1, that indicates that the stock price is going to move with the overall market, right? Sorry, it's one or less, right? It's going to move with the overall market, which basically means as the market fluctuates, that stock price is going to fluctuate at a similar rate. Okay. If the beta is more than one and the higher it goes, the more volatile it is. But that means that it is going to have higher gains when the market is doing well and higher losses when the market is doing poorly than the rest of the market on average. So the beta number can be used pretty efficiently as a way to help you understand how risky a stock is. Now, last thing we're going to take notes on is something called selling short, or second to last thing, sorry. So in both real life and in the stock market simulation that we're going to start on Wednesday, you can buy and sell stocks in what we call buying long. So buying long is where you buy at a lower price and then you hope that the price goes up over time and then you sell it when the price is higher. Right? That is buying long. You also can do something called selling short or a short sell. Now, basically what you're doing is you're selling stock that you borrow from a broker. Short selling, you are betting the price of the stock will go down. Buying long, you think it will go up. Short selling, you think it'll go down. So let's talk about how that actually works. So basically, if I think that the price of a stock is going to go down and I want to bet on that, right? I am going to borrow stock from my stockbroker, sell it, and then buy it back and give my stockbroker back the shares of stock that I got from them later on at a lower price. So let me show you exactly what that looks like. And please write down these steps. So the first step is you borrow shares of stock from your broker. So what that means is that your broker will buy, let's say 100 shares of Apple stock, and then they give those shares to you. So now you owe them not money, but 100 shares of Apple. Then you sell the shares that you borrowed and you get money. Okay. So now you no longer have those stocks, technically. You don't own those shares. Okay. Then you wait for the price of the stocks to drop. And let's say it drops $10, right? And so now the price of Apple stock is $90 per share. And that's as low as I want to go. Then I buy back the 100 shares that I owe my broker at $90 a share and give my broker back the shares of Apple. And so now it cost me nothing to get the original shares, but I sold 100 shares at $100 a piece, right? So I got $10,000, right? Then when the stock price goes down to $90, I buy them back. It only cost me $9,000 to buy the stocks back to cover. And so I made $1,000. Now, the risk is that if the price of the stock starts going up, then when I have to buy back those stocks or buy to cover, that means that then I will lose money. I will be spending more money than I got from the sale. So here's a visual here, right? Short seller borrows 10 shares of ABC stock. Short seller sells those 10 shares for $500. Stock loses value. Short seller buys those 10 shares for $400, which means that I return those shares and then keep the $100. The other thing that exists in the real world but does not exist in our stock market simulation is called buying on the margin. This is when you invest with basically you're borrowing money, taking a loan from your stockbroker that has a fixed rate of interest to be able to buy more stock, right? And then you are going to pay them back. Okay. Now, generally, when it's called buying on the margin, because it's not fully a loan like a bank would give, what happens is you have to have a certain amount of money in your account to be able to buy on the margin. Okay, so you have to have a certain amount of what we call collateral. So if your stock portfolio drops below a certain amount, you might have to pay back that loan or that buying on the margin immediately. Okay, so that is the end of the slides. Now, don't exit out because there's still a couple minutes left of this. And you can write this part down too. But the next thing I want to talk about is we are going to shift gears into starting our stock market simulation on Wednesday. So in order to be prepped for that, you have to do some research today that will allow you to buy some stocks on Wednesday. Okay, so in real life, if you're trying to figure out what companies to buy stock in, you're going to do that based on your goals, based on your investment goals. If you want to make lots of money over a long period of time, low and moderate stocks. If you want to make money really quickly, high risk stocks, right? Et cetera, et cetera. You want to look for companies whose stock prices are going to climb or are low. You want to make sure you're very diversified because you're doing this over a long period of time. Again, the way that I'm going to say this a million times, the way that we invest in the stock market simulation game starting on Wednesday is not how you should invest in real life. Okay. That is every time that Mr. Silvestri or Mr. Brady or I talk to our friends that are, in the stock market world or the investing world, they look at us like we're crazy that we do this. But we simply don't have time to teach you about the stock market and then do like a 6-month or year-long stock market simulation. So do not invest how I'm about to tell you in real life. But in the stock market simulation, you want to be gaining value quickly because it's only about 10 weeks long. Okay. We're going for about 2 months. We'll end on May 2nd. So you need to look where you can gain value quickly. You have to sell stocks quickly, right? You have to pay attention and you have to find companies. Finding companies that are going to post earnings reports is a good call. And there's different lists that exist on different websites. Now, let's talk about what you're actually going to be doing, for the rest of the period. So you should have this handout already. If the sub didn't give this to you yet, please ask them for it. But this is the top part. This is the bottom part. So you're going to do the same thing for 3 different companies. For Wednesday, you have to have 2 of these done. Okay. I will give you a stamp. It will be worth points. So you have to have 2 of these done. So you're going to put the date that you're doing the research, the time that you're doing the research. And then you're going to put the name of the company, previous close price, ticker symbol, open price, exchange, the low price of the day, the current price per share, the high price of the day, the net change, the 52-week range, the dividend yield, if there is any, and the beta number. All of this information will be available to you. Now, the places to look is you can just type in the ticker symbol on Google and use the Google one. You can go to Yahoo Finance. MarketWatch is the website we're going to use for the stock market simulation, so you could use that too. All of these things on this part are things that we looked up about stocks before or read on that assignment last week, except the dividend yield and the beta number. They will be there. Yahoo Finance kind of hides it a little bit, so you may have to look it up a little bit differently, just so you know. Now, if you don't know what some of those things mean, go back to the 3.1 slideshow. The very last slide of the 3.1 slideshow gives a definition of all these terms. Work together if you need to, but I'm telling you right now, if I don't get an email from you, and on Wednesday when I go around to stamp, you say, I didn't do it because I didn't know what these things meant, and I haven't heard from you or seen you, I'm not giving you a stamp, and you will lose points. It's not an excuse to not know what's going on when I give you opportunities to know what's going on. Then down here, you're going to write some bullet points, some sentences to give a summary of what the company does, what does it sell, where is it around, when did it do an IPO and go public, what are some recent changes, why are you wanting to invest in this company, do you think it'll go up, why do you think it'll go up in the next 10 weeks, why is it appealing, things like that. Now that information you'll have to do some Googling, right? Type in that company's name and stock, and then click on news, right? That's a good bet. Now, if you are struggling to figure out companies to think of the products that you buy and the companies that make them. Also, pull up the Dow Jones, look at those 30 stocks, potentially think about one of those. Just because you choose a stock to do research on does not mean that you have to do that. You have to invest in it on Wednesday, but ideally, at least one of these you should be able to invest in. Now, as a reminder, you have to have 2 of these pages done for Wednesday in order to get a stamp. If you do not have 2 pages done, I will not be stamping your assignment and you will lose points. Please email me if you have questions. Remember, 5th period, I'm going to be there before the end of the class period, so make sure you're not messing around because otherwise I'm going to be mad. And for the rest of you, I will see you on Wednesday.